Speaking of Berkshire, the company's vice chair, Charlie Munger, was speaking to shareholders of the Daily Journal today. He weighed in on Wells Fargo, of which Berkshire is the largest shareholder, and the bank's troubled track record.
I think Wells Fargo will end up better off for having made those mistakes. Any bank can make a lot of money by making a bunch of game-year loans at higher interest rates or abusing the customers with very aggressive treatments. And of course, banks really shouldn't do that. And I think as a result of all the trouble, Wells Fargo's customers are going to be better off for this event. And I think it's time for the regulators to let up on Wells Fargo.
Daily Journal itself also has a huge stake relative to its size in Wells, going back to the financial crisis. And so what do you, I mean, I guess it wouldn't be surprising that Munger thinks the regulation has gone too far.
That part is not surprising. The twist on it by saying, you know, maybe it's better that in fact they've gone through this process. I mean, I think that's the way you come to terms with it. It's also worth noting that, of course, Berkshire Hathaway and Munger, of course, have been involved in Wells Fargo from long before they became fixated on number of products per customer, right? In the last several years, they were presenting that as the metric that mattered the most. That got them into trouble in terms of the incentives. So they kind of wanted the franchise from before. And so this shows maybe it does get back to the old way of doing business at Wells Fargo.
Maybe, although,
if they're allowed to.
Today, I think Senator Warren sent them a letter following up on the Journal's reporting about them not reaching out to customers correctly. The shares, though, were up nearly 3% on the day. Munger also discussed the current market environment and what kind of returns investors should be expecting. Take a listen.
When Berkshire came up, we had an easier world than you people are facing from this point forward. And I don't think you're going to get the kind of results we got by just doing what we did. That's not to say that what we did and the attitudes that we had are obsolete or won't be useful. It's just that their prospects are worse.
And they've said this before, Mike, the investment management business is harder now than it was then. Size also makes it hard to keep doing well.
For them, without a doubt. And just the markets in general is so much more efficient, move that much faster. The information flow doesn't get clogged up along the way from the best informed to the least informed the way it used to.
And they do not have kind words for the 1 in 20, 2 in 20 management model, where Munger again singled out Monish Pabrai as somebody who didn't take asset management fee for 10 years until he got back to his high watermark, as saying, you know, this is how Warren did it back in the day. And going back to whether you can emulate that strategy now, he said, you know, why should you pay somebody who's just, you know, you're paying them to invest your money, you're paying them on the profits, but don't pay them to sit there. So repeating a criticism of the money.
Without a doubt. Look, I mean, Berkshire Hathaway itself doesn't take a fee. You just own the shares. And, you know, and of course, Buffett himself has said, start out with an index fund. And Berkshire right now is such a tremendous collection of businesses that's it's kind of a proxy for the sort of best in breed of the U.S. economy, that it's no longer just kind of like the best edgy idea that I have an edge in.
Absolutely, which is what so much of it is about today.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.